Jamie Dimon is warning of cracks in the bond market. What does this mean to you? What might it mean to housing? What might it mean to the economy? We're going to talk about that and more with Mr. Dan Bird. We'll also talk about the jobs number on Friday, give a little taste of CPI inflation the following week. But boy, there is a lot going on. We've got Jamie Dimon warning of cracks in the bond market. We've got the FDIC talking about nearly $500 million in unrealized losses on bank balance sheets. And the final thing, we have a gentleman named Steve Diggle from our Traders Fund who made $3 billion betting against the housing market in the GFC. He has suddenly re-entered the market and is saying, folks, pain is coming. I don't know what's going on, but we've got to look at
What does
rates.
that mean? What does that mean? Is that for the housing market pain?
No, so he's very explicit. He says the area of risk and opportunity this time is not mortgage. It's actually private equity and private credit where the issues are. Says that central banks are not in a position to flood the market with cash. They can't come in with mass QE. We've got inflation in the system, which would be exacerbated by the Fed entering the market. We've got geopolitics, and we've got capital flight from the U.S. So again, basically what Steve is saying is, folks, we have complacent and mispricing of risk, just like before the GFC. So I want to look at rates. I think the 10-year, the 30-year mortgages, all are at significant risk of going higher. And if you're Jamie Dimon, not only does he say cracks are coming, but he warns regulators will panic. Ugh, not good.
Meaning they'll lower the Fed rate.
So what I think Jamie is really talking about is just like Silicon Valley Bank and First Republic, they are going to force banks to merge. Remember, folks, JP Morgan was too big. They were not supposed to grow, but we had that crisis, and guess what? They were the bidder for First Republic, and they grew. So I think what he's really saying is, folks, the banking regulators, once we understand just how bad some commercial banks are, we are going to see lots and lots of consolidation. That's what I think is coming.
Very interesting.
Yeah, it's going to get messy.
Very interesting.
So let's take a look. I wanted to talk about rates first before we get into all the big picture stuff, because I want people to be anchored at where we are today, because the bond market, the bond vigilantes, they move very quickly. And I want everybody to know where we are at today. Today is June 1st, folks. We're all the way into June. So where are we at, Dan?
So I've been saying for a while that the bond market is the one that's going to change things. That Congress won't. Congress will keep spending money. Even Elon Musk stepping away from the Doge is still there, of course, but Elon Musk is stepping away because I kind of don't blame him. That bill that's on the table, it just adds more to the deficit while he's trying to cut.
Yeah.
So even Trump is doing it. So politicians are not going to do it. So the bond market will do it.
That's exactly what I think everybody is saying is guys, you're not paying attention. The bond market is about to get cranky.
Yeah, it'll be interesting to see what actually plays out. I don't necessarily think that is wrong. I just question the timing.
Oh, so that's fair. That's very fair.
So I think all of those people, Jamie Dimon, all of them, I think will be proven to be correct,
but maybe early.
Just not yet.
Okay. All right. Well, let's at least anchor everybody where we're at today. You're Mr. Chart Man, so why don't you show us where we're at so we can be grounded? And
all right, let me show you first. First one I want to show is one that I couldn't find last week. Okay. So we were talking about. So here's my website for those that are interested, breakpointtrading.net, and you can get my YouTube channel right at the upper right. Just click on that. It'll take you straight there. My newsletter, it's free. Click on this box. You can get the newsletter. I actually want to show you something that I put in there kind of along this conversation. But first, let me show you the US dollar. And if you remember the conversation, you said the US dollar has fallen 10%, and it may easily fall another 10%.
Correct. That was last week. You can look it up in his playlist. Yep.
Right. So here is the dollar, and
Yeah,
yes,
that's
it's
10%.
fallen
Yeah.
from 110 down to 100. So yes,
99.09, it looks like.
right. 99.33
Oh, wrong side.
as of the close on Friday.
Gotcha.
Um, so yes, it's fallen 10%, but it is at the midpoint of a almost 40-year cycle.
Hmm. Okay.
It's at the midpoint. Over 40 years, it's at the midpoint.
Gotcha.
So, if you started looking at it when it was right here, then you might be really worried that it's
Mhm.
fallen all the way to here. It was at 115 up here.
Okay.
But if you look at it in perspective, it's not even halfway to where it always is.
Hmm.
So what happens if it falls another 10%? So that puts it at 90 right
Right.
here. Well, that's pretty much where the lows were in 2018 and 2020.
Yeah. So what I take from this chart is 90 is very possible. And
Yeah, 90 is
may,
very
may,
not only is 90 very possible, 90 is without likely in the realm of possibility and not something to be jumping up and down concerned about.
yeah. Yeah, it's not whatever that is, 70, the bottom that you have there.
Yeah, down here at 70, that was in 2008.
Hmm.
That was the bottom. That would be
Gotcha.
concerning.
Okay.
In fact, if it dropped through this lower quadrant down here, which is below 84, 83, 84,
Right.
that would start to be concerning as well. You can see how solid that support level has been over 40 years.
Right.
Each time it gets down, except for the financial crisis, which at the time everyone thought the world was ending,
Hmm.
right?
Yeah. The
So
interesting
yes,
there is it stayed there for roughly 5 years.
uh, yeah. I mean the low itself was just about 6 months or less,
Right.
right
Right.
there. But and it bounced back up and then came back down again in 2011, and then started going higher.
Okay.
So yes, it could fall. It could fall from here. I talked before about liquidity. A lower dollar is good in general
Hmm.
because it improves liquidity, global liquidity, and markets cannot go up without liquidity.
Right.
All right. So all of this, and look at gold. Gold
Hmm.
is gold sending us a message too?
Yeah. Well, again,
Way
I
up
think
there.
one of the things that's going on is you're seeing capital flight from U.S. dominated assets, and gold is just the first winner in that
Yeah.
trade. I think.
Yeah. I don't disagree with that. I think lots of countries, and China in particular, are stockpiling gold right now.
Mhm. Yep.
We'll see how long that lasts. The other thing that's interesting is it's one thing to look at individual trajectories of individual assets,
Hmm.
and clearly gold is almost perpendicular, which is not sustainable,
Right.
right? But the other way to look at it is how does it do versus other assets?
Hmm.
So how is gold doing versus the dollar? Well, it's doing really well versus the dollar. Gold's going up, the dollar's going down. So that's sort of to be expected. But how is gold doing versus the S&P? Well, even with this big run up here, it's pretty much been sort of
Yeah.
right
Flat.
along since 2020, kind of doing
Hmm.
nothing versus the S&P.
Hmm.
In fact, many times you'd be better off being in the S&P than in gold,
Hmm.
right? So it's not just a matter of looking at individual asset classes, it's looking at the total picture, and where would your money be best served,
I
basically.
like it. I like it. Good view.
So just always put things in perspective. Most people, when they look at charts, usually look at the last year. This little section right in here, and
Hmm.
I like to go back and look at 35 or 40 years to
Hmm.
see where the midpoint is.
Got it.
Interestingly, the dollar was way up here back in the 80s when interest rates were so
Yeah.
high.
Interest rates were double digits. There's the reason for
Yeah,
that. Yeah.
dollar was way up there. All right, let's look at. Let me see. Here's the interest rate chart.
Nice.
So this one here also goes back to 1990, so
Okay.
35 years. And this is the Fed rate is the green one rolling over. The 2 year is the gray one, the 10 year is the pink one, and the 30 year is the light blue one.
Okay.
So the first thing that should jump out is the Fed rate every time just before a recession rolls over, just like it looks right now.
Mm-hmm.
All right. And I've talked about this before when everyone was talking about the Fed cutting rates. I said, be careful what you ask for, because after the first rate cut, we usually get a recession. Now, that hasn't happened.
True.
And we'll talk about that in a second. But what about the rest of these? 30 year? I mean, 30 years coming down. The 10 year started to come down, but it's now starting to move back up. So, to your point of what all those folks are saying, is the 10 year is going to go higher because people are going to stop buying bonds.
Well, I think there's a lot of things going on that make this cross current really bad. We obviously have a fiscal crisis going on. The promise of the big beautiful bill is not reducing debt, it's adding and adding big. We also have capital flight. I talked about a section in the big beautiful bill, section 899, people can go look it up, where they're actually looking at potentially taxing investors from certain country an extra 5% a year up to 20%. And all that's going to do is, if you treat capital poorly, it's going to leave.
Yeah.
So if you give more and more reason for investors from Europe, Japan, all over the world not to invest here, that means they're going to exit and stop deploying capital here, which is a horrible idea when you have to refi the balance sheet to the tune of, I don't know, $8 trillion in the next 6 months. We're forcing capital flight, and we're adding, it's just recipe for disaster.
Yes, possibly. And then, did you see the news last week?
Which news?
The deficit cut in half
I did not see that. What
for the first time ever.
All right, tell me what's going on. The deficit went down a half. What?
Well, here's some of the this one here. Inflation eases, incomes rise, trade deficit plummets. But the next one, this one here, is Rick Santelli, who was just incredulous. This is when core PCE, when all of these were announced on Friday, and he was doing it live. He was looking at these numbers live, and he said, talking about the deficit, wow, it comes in much, much smaller, minus 87 billion. Now this falls at 163 that converted to 162 with a minus. The worst since record keeping in 1989. We cut it in half to 87.6. He went on to say he has never seen that happen before. Never.
Okay. All right. So he's obviously talking about trade deficits, not the national deficit. I got confused.
I'm sorry. Trade deficits.
Yeah. Yeah. No, I did see this on Friday. And again, what is this? We implemented a bunch of tariffs that forced businesses and consumers to change behavior. Last month, it was buy ahead and buy a lot. Then we stopped buying. Then these 90-day towers. This is such a dirty number that means absolutely nothing until we get next month.
Yeah, I would not characterize it as we stop buying. I would characterize it as change behavior.
Of course. Yeah.
But change behavior does not mean stop buying.
Fair enough. Buy different. Yes, correct. Okay.
Right.
Yep.
So you just buy different things. You buy the things that are cheaper.
Yeah. Yeah. Or you find another location. Absolutely. Yep.
Right. So all of this, in addition to.
No, you want to talk about the Friday numbers. The Friday number that I thought was most important that nobody talked about? It was the savings rate. Did you see the savings rate explode from 0.6 the previous month to 4.6?
I did not know that. No.
That is the biggest number of Friday's news release that nobody picked up. Why is that? That is consumers fundamentally sitting on their wallets and doing nothing. The U.S. consumer does not do that, but they did it last month.
Well, they don't do it unless they think inflation is going to go much lower.
No, they only do it when they're afraid. They're afraid.
And that's not true. They do it when they think prices will be cheaper in the future. That's also why they do it.
Well, it's certainly, yes. If you look at the economic thing, yes. If you have deflation, which is not something the U.S. has had in years, But
Right.
yes, normal consumer behavior is if you have deflation, people wait because they expect it to go cheaper.
Right.
That's
And we
not what
talked
happened last month.
and we talked about that last week.
We did.
That change of behavior starts to feed on itself.
It can, yeah. Deflation is a nasty spiral. That's not what happened last month. Last month we had tariffs implemented, we had this, we had that, and you just had consumers go, no mas, I give up, too hard. And they saved a bunch of money, 4.6% up from 0.6. That is a big number.
Yeah, it is. That's interesting.
Yep. All right. So again, we've got a lot of stuff going on. We got a lot of important numbers.
How does that play into Jamie Dimon's comments about banks being forced to buy weaker banks? If consumers are saving more money, the banks have more.
True, but unfortunately, it's not about the net new money. It's about their balance sheets being impaired from past deals. They are doing they're marking these things as carry to maturity,
Right.
and it's not sure that they can. This may be a Silicon Valley bank where if you get a run on the bank, you have to suddenly go from hold to maturity to mark to market, and you're going to be illiquid very, very quickly.
So do you think that's because the 10-year rate's going to go up?
Yeah, I think the 10-year and 30-year are going to go up. And I also think commercial loans are going, you can only extend and pretend so long with commercial loans. And I think the party is just about to end, and you're going to get a lot of Class B and Class C assets marked to market, and that's going to be a death blow to liquidity.
So far, the 10-year is not really showing any signs of going up.
I
Came
don't
down,
know.
came down last week.
Sure, a little bit. Let's see. This is all about what's on the next 6 weeks.
No, I understand. I understand that. And 6 weeks from now, we'll look at this chart again and
there you go.
look at things in the rearview mirror. But right now, it's not really giving us any clues. Here's a 20-year bond versus the S&P. It's been down. 10-year versus the German 10-year. It's going up. And the 20-year is going up right now.
Yep. Yeah, there was a really poor 20-year auction. I think it was the week before.
Yeah, the week before. You could call it a failed auction, but the right when that auction occurred, the 20-year went up instead of down.
Now those are just so I'm clear, is the chart looking at rate or price?
The chart is looking at this is the 10-year, the solid one in the foreground.
Got it.
So that's the 10-year yield.
Got it.
Right here. It's at 4.4.
Got it. Okay.
And this is the 20-year bond. So these should
the value.
These should go in opposite directions of each other.
Got it. Okay.
Which they often do.
Right. Yep.
All right. So let's just, for fun, look at this going back 20 years, 25 years. So there's 25 years, and you can see the mirror image on those.
Yep.
Yeah, the 10-year actually is trending down. So, I mean, it's great for all these folks that want to say these insightful things, but it's been trending down. So until it get back above 5, I am going to question that thesis. Awesome. If it gets back above 5, then yes, that could be the case. But right now it is trending down.
Okay.
And I believe that the Fed is going to cut probably sooner than expected. Everyone's, even including the Fed governors, are saying that the Fed's, going to wait. I think they will cut sooner than people think.
And now is that because the job market deteriorates?
Mostly because all of that debt's coming due. So they're going to try to push the long end down. They don't have a lot of control over it, but we'll see. So this goes back.
So hold on. So let's say you're right. Let's just play this out together. Let's say out of, in the next 90 days, they whack the Fed funds rate 0.5%. So 2 cuts. I don't agree with that, but let's just play this out.
Okay.
Who's to say that the long end goes down?
Well, it may not, and it hasn't recently. That hasn't happened. Let's see. I don't know if I can go back more than 25. And there's 30. There's 30 years right there.
Yeah.
So back here in 1996, 97,
Yeah.
10-year was at 7%.
Yeah. It's just, I think we have like almost a Molotov cocktail of things merging together that are just bad timing, right? We've got banks with impaired balance sheets. We have capital flight, um, and we have a need to refi our own balance sheet, our own debt. And to Jamie Dimon's point, he thinks that something's going to break, and then it's going to force the regulators to frankly overreact. So
Yeah,
interesting.
that very well could be true. I mean, the economy in general has been really strong, and it continues to be strong. And there was calls last year for a recession. I even thought we'd have a recession by now.
Sure. Mm-hmm.
But instead, the numbers are coming in stronger. Now, we're going to get another important one next Friday with the
Yeah, the
jobs
jobs
number.
number. Yeah, I
We'll
got
just take it.
I wrote down that they're expecting 125,000 jobs created
Yeah,
for the month.
I thought it was. I thought I saw 130, but
Yeah,
actually,
close enough.
let me go open my newsletter. And every week, I put in the economic calendar for the coming week.
Yep. Yeah, 130 is what you had.
Yeah, 130. So with unemployment staying static at 4.2.
Yeah. Okay.
So the payrolls number going down, which I don't pay that much attention to, frankly.
Mm-hmm.
The unemployment rate is more important. As we saw in the last 4 years, this number can be easily manipulated.
And revised endlessly. Well, let me
Yeah,
ask this. Let's play the what if game. Let's say Friday comes and I guess we play both sides. Let's say there's a bad jobs number, and let's say that means something less than 75,000 created, and the unemployment rate goes from 4.2 to 4.3. And
right.
then we'll play the other side that 200,000 jobs are created and the unemployment rate stays flat. I think those are kind of the ends of the spectrum. Which one do you want to talk about first?
I I would take your first one as most
Yeah.
likely.
Yeah, me too. I think there's a very good chance that this number is not triple digits. I would, if you gave the numbers over under as 100, I'm taking the under on this one.
100 jobs, 100,000 jobs.
Yeah, I'm going for
Yeah,
the under.
I'm not gonna bet on this number here.
Yeah. Okay. And
That's
then
a
what do you
fool's
think?
bet. That's a fool's
Yeah.
bet, I think.
Okay.
This is the number I would bet on, and I think it will go to 4.3.
Okay. I think so too. I think it goes to 4.3.
And here's my chart. So this is what I look at before the jobs number comes out. You can see this is unemployment claims,
Mm-hmm.
right? And we can compare it to the month before. In fact, month before is this line right here. I'm going to try something here. Let's just make another one of these. Move it over to last month. So there's last month's.
Mm-hmm.
Make it blue.
Gotcha.
All right. So there's last month and there's this month. They look pretty similar.
Yeah, the other thing that I don't know if you have in here, and it may be in the chart, and I just don't see it. I think the bigger issue is not the unemployment rate, 4.2, 4.3. It's actually continuing claims.
Yeah,
Last week,
I'll look at that in a second.
yeah, last week we put in a
But
cycle high at 1.9 something.
right, yeah, I don't disagree with that. That's the one we really should watch more than anything. But this is the one that might tell us what that number will be. So
Yep.
it's kind of looks like a reverse image. The first couple of weeks of this month look like a reverse image of the last couple of weeks of last month
Mm,
so far.
yeah,
So I would call that a net zero,
probably. Yeah.
zero sum. But the beginning of last month was much lower.
Mm-hmm.
So I think what's going to, and they haven't painted the bar for this past week, this most recent week.
Right.
If that bar comes in much higher, and it probably will get in here before the number next Friday, and I'll show it. I'll keep looking at it. And I'll show it on my midday update during the week on my YouTube channel.
Awesome.
But if this number gets much higher than what it is, if we get at least one more red bar in here, red just means it's higher than the week before.
Right.
Green means it's lower than the week before. All right. If we get one more red bar right here, then I'm definitely going to go with 4.3.
Yeah, me too.
On the unemployment rate.
I agree with that.
All right. So let's take a look at the continuing claims. So the red in the background, or the line, you can look at the line as well. Red is continuing claims. It's going up slightly, but so are initial claims. They're both going up.
Yep.
Right? And this line up here is a relative comparison. So if it's trending higher, that means, let's see, that's initial claims versus continuing claims. That means initial claims are climbing faster than continuing claims.
Interesting. Okay.
All right. But continuing claims are not coming down.
Yeah.
So that's the important takeaway from this.
Yeah. It's very,
you don't want those continuing claims to just keep going up month after month, and initial claims go up too. That's a recipe for disaster.
Agreed. And that's what I think that's what I think it's going to boil down to is I think this is going to be, I think the unemployment rate's going to shock people and not go as high, but continuing claims are going to get worse and worse, which just means you have duration on unemployment.
Yeah, right. And the other thing that happens with unemployment, and the Fed knows this very well, that once it starts to go up, it will accelerate higher.
Elevator takes the elevator. Yep.
Right. So the Fed knows that too. So they're gonna be watching that number very closely to see what they do. This is the June from Stock Traders Almanac, what June typically looks like, and you can see the beginning next week basically. It's fairly bullish for the first week. There's until the jobs number. Oops, sorry. Keep forgetting I can't click on a PowerPoint. The jobs number up here on Friday, and then it declines right into this really important week where we got the FOMC meeting on the 18th, we got the CPI number on the 11th, and we got options expiration. All of this in the same week. And then, of course, a holiday for Juneteenth right in the middle of it. So CPI, we'll talk about that next week.
Yep.
And then the Fed meeting, which they likely will not do anything at this meeting. I mean, there's really nothing, there's no red flags right now in the economy. Even if we get a 4.3 number on unemployment, the Fed is expecting 4.4 this year.
Right. Yeah, the big thing about this FOMC meeting is we're going to get another dot plot. It'll be interesting to see. I'm going to guess that 4.4 goes higher, but we'll see.
maybe so. We'll see. All right. I showed this on my midweek update, but this is a chart that I found, and then I drew in the secular bull and bear, the reds and blues, reds and greens. So this just gives you a sense for the magnitude of the moves. During secular bears, you've got down 51 and down 58%, and the length of time, 1165 days and 1,000 days. During a secular bull market, you got down 28, down 21, down 35, and the number of days to recover. 2022 was a cyclical bear, 300. That was the longest, 300 days to recover.
Yeah.
And COVID was only 23 days, of course. But we're a little further into this. We're almost back to the top, and we could very easily, very likely, get to new highs by the end of the year.
Yeah, I think it's Tom Lee from Fundstrat. He's calling for all-time highs.
Right. Yeah, I think that's very likely by the end of the year. So I would say all of those things are doom and gloom reports from what you would think are very respected folks, Jamie
Sure.
Dimon, of course.
Yep.
The last thing I want to leave you with, unless you want to look at
No.
other actually there is one other thing that I'll do. I want to show you something about industry groups, but
Okay.
I want to go back to my newsletter, and I always put in excerpts from Real Investment. Let's see if there's anything else. This is my dividend scan that I run at the beginning of the year. So at the end of each month, I put in what the status of these look like. So three different scans for dividends, and you can see this month most of them are going up, but it's the Vanguard high yield ones that it's really blowing everything else away. Right there, 8.65% for the year to date. Wow. So far. Nice. But I want to show you an excerpt from this excerpt. First of all, this is again the rebounds that we've seen. This is from Real Investment Advice, which is really, this guy does really, really good research, mostly around the market and historical trends and things like that. So trailing 4-quarter earnings growth is declining. So that will eventually show up. This is kind of the psychological factors that most people look at. This is the one right here. Ray Dalio is predicting, and this is the headline of one of his things. Ray Dalio predicting a financial crisis again. ...
Again.
Right. History of faulty predictions. And there's all the ones that he predicted down here. And, very similar to what I'm hearing right now, but I don't see the data supporting it. At least not yet. At least not yet.
I like
doesn't mean that it won't eventually, but I would just, for any of these things, take it with a grain of salt. Let price be your guide, not all of the noise in the market. If you're in the stock market, I should say, let price be your guide, not the noise in the market, not the noise from the talking heads.
Wise advice. You wanted to show us one more thing?
Yeah, one of the things that I worked on this weekend, I was just curious if I could figure out a way to identify the best sectors. So I actually created a scan, the best industry groups. So I created a scan for the best industries, and there are a total of 105 industries.
Oh, wow.
And the scan returned just 21. So these are the ones. Folks can, I put it all on there. You can take a picture of it if you want. Right now, this is over the last 90 days.
Okay.
All right. So if you want to beat the S&P in the market, then the best way to do that is to find stocks in industries that are beating the S&P.
Got it. Okay.
And all 21 of these out of 105 total. So about 20% of all industry groups, these are the ones that are beating the S&P right now and going higher. So those are the ones that you should look for opportunities in if you also want to beat the market. And this is something that I'm going to do in my daily scan that I do on the midday update. My midday update have been like 7 minutes.
Oh, beautiful.
So they're very quick. I look at what the market's doing right now. I look at a 10-minute chart halfway through the day. And then I do a daily scan. I actually get it in my email automatically. I just show the scans that I've received for stocks that are going up that morning. And then at the end of the day, we can look at them and see what happened. But those give some really good clues to, if people want to find something to buy, really good clues to stocks to buy. And the list that I use for that are only stocks that have weekly options. Okay. So that means they are highly liquid, usually very large companies.
Yeah, you're not scraping the bottom, as you would say.
Right, exactly. And then I want to do something to I'm trying to figure out the way to create a scan with this list of the best industries against that list to see which of those are in the best industry groups at the same time.
Interesting.
So theoretically, that should give you the best of the best. So that's something that I'm working on, and I'll probably introduce it on one of the midday updates.
Well, folks, if you haven't subscribed to Mr. Dan Bird's channel, I don't know what you're doing. He's doing midday updates now, daily wrap ups. He has been proven right in time and time again on this channel. Go subscribe to his YouTube channel right now. Dan, closing thoughts?
Right there. Yeah. My closing thought is next week could be bullish for the market. Then we're going to be very choppy, probably down until the third week of June. So roughly about 2 or 3 weeks. And then as I've showed, I think the last time I showed from the third week of June till July 15th is bullish. Going back to 2017, the only year that it hasn't been higher was 2022, which is a cyclical bear market. And then watch out after that. So all of those things that you talked about, if they start to come to fruition around the middle of July, from the middle of July until the end of October, it's going to be a very tough market. And I think that'll probably play out this year as well. So we'll see. We'll see about all those predictions. We'll continue to check in on that as we go through. And then we'll see if the data starts to support it as well.
Awesome. I love it, Dan. Well, thank you for coming back each and every week. Thank you for being here for years now. But most importantly, thank you for starting your own YouTube channel. I'm getting great feedback from folks. Thank you and good luck.
I encourage people to give me their comments, ask me to look at certain things. Some people have asked about stocks. Some have just asked about, can you show a chart about liquidity so we can see what that looks like? So they give me some really good ideas on the channel to create things that everybody can then use.
Yeah, I love it. Man, you're amazing. Take care. Have a great week.
All right. Have a good weekend.